Welcome back to We Are Cosmic, the channel where we don't chase hype, we break down the architecture behind global finance and crypto from an expert, data-driven perspective. If you are new here, this channel is about understanding how money actually moves, who controls liquidity, and why certain digital assets were designed very differently from what most people think. Today's video is not about price predictions or short-term pumps. This is about structure, intent, and power. Let me start with a question that might sound uncomfortable. What if one digital asset was designed from day one to hold enough liquidity to absorb the entire global financial system? Not compete with it, not disrupt it slowly, but eventually replace the plumbing that moves trillions of dollars every single day. This is not a conspiracy theory, and it's not a meme. It is the foundational design logic behind XRP. Most people look at XRP and only see the price on a chart. What they miss is that XRP was never designed like Bitcoin. Bitcoin was born in chaos after a financial crisis with mining, scarcity narratives, and ideological decentralization at its core. XRP was born with a very different mission. It was designed as a solution for banks, institutions, and cross-border payments at a global scale. And that one difference changes everything. From the very first moment the XRP ledger went live in 2012, all 100 billion XRP were created in a single event. No mining, no gradual issuance, no uncertainty about future supply. That decision alone tells you this was not built for retail speculation. It was built for predictability, liquidity, and institutional confidence. Banks do not operate in systems where supply is unpredictable. They require certainty, depth, and control over liquidity flows. Out of those 100 billion XRP, around 80 billion were allocated to Ripple Labs, while 20 billion went to the founders to help seed the ecosystem. This allocation immediately created controversy, and honestly, it still does today. Critics said it looked too centralized. Supporters argued that without a massive ready-made liquidity pool, XRP could never replace systems like SWIFT. Both sides had a point, but the market missed the bigger picture. If your goal is to move billions of dollars across borders in seconds, you cannot rely on a slow proof-of-work issuance model. You cannot wait years for liquidity to organically build. You need value up front. XRP was designed to be that value. It was not a retail experiment. It was financial infrastructure. In the early years, Ripple did not treat its XRP holdings like a casual treasury. It was a strategic reserve. XRP was used to incentivize partners, build corridors, and test real-world payment flows. However, the lack of transparency around how much XRP could enter the market created fear. Markets hate uncertainty, and for years, the idea that Ripple could sell large amounts of XRP at any time weighed heavily on price action. This pressure forced one of the most important decisions in crypto history. In 2017, Ripple locked 55 billion XRP into cryptographic escrow contracts. This was not marketing. This was a structural move. The blockchain itself now controlled the release of XRP, not Ripple executives. Every month, 1 billion XRP could be released, and whatever was not used would automatically be locked back up. This move changed the narrative completely. It turned XRP from a feared supply risk into one of the most predictable supply systems in crypto. Institutions understood this immediately. Retail investors, for the most part, did not, and this brings us to where we are now in 2026. The real story of XRP is not about dumping. It is about controlled liquidity, long-term planning, and a system that was built to scale to global finance. The question is no longer, why does Ripple hold so much XRP? The real question is what happens if they didn't. Because in the next part, we are going to break down how the escrow system actually works, why most of the released XRP never touches the open market, and why the fear around monthly unlocks is mostly psychological, not mathematical. Now that you understand why XRP was created with its full supply up front, we need to address the biggest misunderstanding in the XRP ecosystem, the escrow system. This is where most retail investors get confused, emotional, and often misled by headlines. You've probably seen it before. Every month, the same story appears: 1 billion XRP unlocked. For many traders, that single sentence triggers fear. They imagine Ripple dumping billions of dollars onto the market, crushing price, and walking away with profits. But that narrative ignores how the system actually works. In late 2017, Ripple locked 55 billion XRP into cryptographically controlled escrow contracts. These are not promises, they are not press releases, they are on-chain rules enforced by the XRP ledger itself. Ripple cannot bypass them, they cannot accelerate them, they cannot unlock more than what the system allows. On the first day of each month, 1 billion XRP becomes available. That is the maximum, not the minimum. The key detail is what happens next. If Ripple does not use those tokens for operational purposes, partnerships, liquidity provisioning, or institutional agreements, the unused portion is automatically relocked and placed at the back of the escrow queue. This means the supply timeline is flexible, not aggressive. The more XRP Ripple does not use, the longer the escrow lasts. What was originally designed as a 55-month release schedule has now stretched well into the 2030s. That alone should tell you something important. Ripple is not in a rush to sell. Let's look at what actually happened in January 2026. 1 billion XRP was unlocked just like every other month, but roughly 700 million XRP was immediately relocked. Only around 300 million XRP remained available for strategic use. That is not dumping. That is controlled liquidity management. And this pattern is not new. If you look at the last 12 months, you will see the same behavior repeated again and again. Large portions of unlocked XRP are sent straight back into escrow. This tells us two things. First, Ripple does not need to sell aggressively to fund operations. Second, XRP demand at the institutional level is being managed carefully, not flooded into open markets. So why does the fear persist? Because psychologically, markets react to headlines, not data. Unlocked sounds dangerous. Relocked rarely makes the news. Here's the deeper truth. Ripple is managing the largest private liquidity reserve in the digital asset space, and they are doing it more like a central bank than a startup. Liquidity is released only when it serves a purpose. Payments corridors, on-demand liquidity, institutional settlements, and now stablecoin infrastructure like RLUSD. This is where XRP starts to look very different from other crypto assets. Most projects want scarcity for price. XRP needs liquidity for function. A bridge asset cannot work if there isn't enough depth to move large value without slippage. Think about it this way. If a bank needs to move $10 billion across borders, they cannot rely on thin markets. They need guaranteed access to deep pools of value. Ripple's escrow exists to guarantee that depth. In 2026, the market reality has started to catch up. On-chain data shows that the monthly escrow releases have little to no direct correlation with major price drops anymore. The fear has slowly decoupled from reality. Price is now responding more to utility growth than supply mechanics. This is why calling the escrow a dump mechanism is outdated. It is a liquidity valve, not a sell button. Ripple releases what the system needs and nothing more. The irony is this. Retail traders worry about Ripple selling XRP, while institutions worry about whether there is enough XRP available when they need it. Two completely opposite perspectives. And this sets the stage for the next critical discussion. Because once you understand that XRP supply is being controlled, not inflated, the next question becomes unavoidable. What happens if XRP becomes essential to global finance? What happens if the demand for liquidity exceeds what is actually liquid? Now that we've cleared the biggest misconception around XRP's supply and escrow, we can finally address the number that makes most people uncomfortable: $40 trillion. Every time this figure comes up, it gets dismissed as fantasy, clickbait, or pure speculation. But here's the truth. The $40 trillion conversation is not about price excitement. It's about system capacity. To understand this, you need to stop thinking about XRP like a stock or a meme coin. XRP is not designed to sit in wallets and wait for appreciation. It is designed to move value. And when you talk about moving value at a global level, price becomes a technical requirement, not a marketing goal. Let's look at how global finance actually works. Every single day, trillions of dollars move through cross-border payment systems. SWIFT alone processes over $5 trillion daily. These are not speculative trades. These are salaries, trade settlements, government payments, energy contracts, and sovereign obligations. XRP was built to sit in the middle of this flow as a bridge asset. Here's where the math gets uncomfortable. If XRP were priced at $1, moving $10 billion would require 10 billion XRP. That would represent a massive portion of the liquid supply moving at once, creating slippage, volatility, and instability. In simple terms, the pipe would be too small for the water. A bridge asset cannot be cheap if it is expected to carry enormous value. Low price equals low efficiency. This is the part both the extreme bulls and the extreme skeptics often miss. Price is not a reward, Price is a requirement. Now let's raise the price. At $100 per XRP, that same $10 billion transaction only requires 100 million XRP. Market impact drops dramatically. Liquidity becomes smoother. Slippage becomes manageable. At $1,000 per XRP, the system becomes even more efficient, allowing multiple high-value transactions to settle simultaneously without disrupting the market. This is why the $400 to $1,000 price range keeps appearing in serious institutional models. Not because it sounds exciting, but because anything significantly lower creates friction. And friction is unacceptable in global finance. Now let's connect this to Ripple's holdings. If Ripple is managing a liquidity reserve meant to support global corridors, that reserve must be valuable enough to function as financial infrastructure. At a $1,000 price, XRP's total market value would exceed most asset classes on Earth: gold, real estate. Even broad money supply metrics like M2 start to look small in comparison. That sounds insane until you remember what XRP is replacing. Not a product, not a company, an entire layer of global financial plumbing. When people say XRP can't be worth that much, what they're really saying is, I can't imagine one asset being trusted to move that much value. But that trust is already forming. Central banks, payment providers, and financial institutions are not experimenting anymore. They are integrating. This is also why Ripple's balance sheet matters. If Ripple's holdings ever reach tens of trillions in valuation, it means the global financial system has already shifted. XRP would not be driving the change, it would be reflecting it. And here's the part that really flips the narrative. If XRP does not reach higher valuations, it cannot perform its intended role. A low-priced XRP is not conservative, it is broken. This is why we are now seeing a transition in 2026 from viewing XRP as an investment to viewing it as utility. Value is no longer being derived from speculation alone. It is being forced upward by usage. The more value that moves through the ledger, the higher the floor price must rise to support it. This brings us to a critical realization. The market is not asking whether XRP can go higher. The system is asking whether it can afford not to. In the next part, we are going to expose the supply illusion. Why circulating supply is a misleading concept, how institutional agreements quietly remove XRP from the public market, and why retail investors are competing over a much smaller pool than they realize. Before we move on, answer this honestly. If XRP hit $1,000 tomorrow, would you sell immediately, or would you realize that selling a critical utility asset might be a bigger risk than holding it? Drop your thoughts below. This is not about being bullish or bearish. It's about understanding the role XRP is being pushed into. Now that we understand why XRP needs a high price to function, we have to confront another uncomfortable truth. The idea of circulating supply is mostly a myth. On tracking websites, you see a number that looks large and reassuring. Tens of billions of XRP appear to be freely available. But in reality, the amount of XRP that can actually be bought at scale is far smaller. Retail investors assume that supply equals accessibility. Institutions know better. What matters is liquid supply, not theoretical supply. In 2026, the majority of XRP is not sitting on exchanges waiting for a retail buy order. A growing portion is locked into institutional agreements, operational reserves, on-demand liquidity corridors, and long-term strategic holdings. These tokens may technically be circulating, but functionally, they are removed from the market. This creates a two-tier XRP economy. On one side, you have retail participants trading a relatively small float on public exchanges. On the other side, you have institutions accessing XRP through over-the-counter deals, private liquidity agreements, and direct partnerships with Ripple. These XRP never touch the open market. They are acquired, used, and often held within closed systems. This is why retail price action often feels disconnected from what's happening behind the scenes. While traders argue over candles, institutions are negotiating access to liquidity pools measured in billions. When a bank needs to move value, they do not open a trading app. They call Ripple. This is where the supply squeeze quietly begins. Every time XRP is allocated to an institutional corridor, it becomes less available to the public market. Over time, this reduces effective float. Price pressure builds not because of hype, but because of scarcity at the point of execution. Another key detail most people miss is velocity. XRP used for utility moves quickly, but it doesn't necessarily return to exchanges. Many tokens are locked into repetitive settlement loops, serving the same corridors over and over again. Others sit idle as guaranteed reserves, ready to deploy instantly when needed. Meanwhile, a large portion of retail-held XRP remains dormant in wallets, waiting for price appreciation. These tokens are not contributing to liquidity. They are spectators, not participants. When you combine institutional lockups, operational reserves, escrow management, and dormant retail holdings, the true liquid supply becomes surprisingly tight. This is the invisible force behind XRP's long-term valuation potential. Now let's talk about power. Ripple's holdings are not just assets, they are leverage. When a central bank or payment provider needs deep liquidity, Ripple becomes the gatekeeper. This doesn't mean Ripple controls the ledger, but it does mean they control access to scale. This is why the relationship between Ripple and institutions matters more than exchange volume. XRP is evolving into infrastructure, not a commodity. And here's the part that makes many crypto purists uncomfortable. This structure looks less like decentralized chaos and more like regulated financial plumbing. For some, that's a betrayal of crypto's original vision. For others, it's the only way mass adoption was ever going to happen. The result is a market that behaves differently than most cryptocurrencies. Price doesn't explode overnight, it compresses, it builds pressure, and when demand spikes, supply cannot respond quickly. This is why XRP often feels suppressed to retail traders. It's not suppression, it's allocation. But this design comes with a risk, a big one. When so much supply is concentrated in institutional hands, questions about control become unavoidable. Is XRP truly decentralized enough? What happens if Ripple becomes too powerful? What happens if trust breaks? This brings us to the biggest vulnerability in the entire XRP thesis. In the next part, we are going to confront the centralization debate head on. We will talk about validators, perception of control, market psychology, and why XRP's greatest strength could also be its greatest weakness. Before we move on, ask yourself this. If institutions are quietly removing XRP from the open market, are retail investors early, or are they liquidity providers without realizing it? Share your thoughts in the comments. This is where opinions really start to split. Up to this point, everything we've discussed builds a powerful case for XRP as global financial infrastructure. But no serious analysis is complete without confronting the risk that sits at the center of this entire system: control. XRP's institutional alignment is its greatest advantage, but it is also the source of its most dangerous vulnerability. Crypto was born as a response to centralized financial power. XRP, by contrast, works with that power, and that creates a philosophical and practical conflict that cannot be ignored. The concern is not imaginary. Ripple still holds a significant portion of the total XRP supply. Even with escrow restrictions, the perception remains that one company has outsized influence. In financial markets, perception matters almost as much as reality. Critics argue that XRP resembles a private central bank more than a decentralized asset. If Ripple acts as the primary market maker, liquidity provider, and institutional gateway, then the system inherits a single point of failure. If Ripple fails, stalls, or faces regulatory pressure, the entire ecosystem feels the impact. This fear shows up clearly in market psychology. Every time XRP approaches a breakout, the escrow narrative resurfaces. Traders don't ask whether Ripple will sell. They ask whether Ripple could. That uncertainty places a psychological ceiling on price action. And yet, institutions see the same structure as a feature, not a flaw. Banks do not want chaos. They want reliability, accountability, and predictable governance. From their perspective, Ripple's involvement reduces risk. Someone is responsible, someone maintains relationships, someone provides guaranteed liquidity. This creates a split market reality. Retail investors demand decentralization, institutions demand control. XRP sits uncomfortably in the middle. Now let's talk about validators, because this is where the debate often gets distorted. The XRP ledger does not use mining. It uses a consensus model with validators. In 2026, many validators are independent, but Ripple still influences a meaningful portion through trusted node lists and infrastructure support. This does not mean Ripple can rewrite the ledger at will, but it does mean that decentralization is not as clean or simple as Bitcoin or Ethereum maximalists would prefer. So the real question becomes this: is partial centralization acceptable if it enables global scale adoption? Because here is the hard truth. No fully decentralized system has yet replaced global finance. XRP might be attempting something that pure decentralization cannot achieve alone. Still, The risk remains. Trusting one corporation with a system that could move tens of trillions of dollars requires faith in governance, transparency, and long-term alignment. If that trust breaks, the consequences would be massive. This is why risk management matters more than belief. Before we go further, let me be very clear. Nothing in this video is financial advice. Crypto markets are volatile, and you are responsible for your own capital. Hope is not a strategy. Personally, I manage risk by spreading exposure across multiple regulated exchanges and maintaining redundancy. No single platform, no single point of failure. The tools and platforms I use are linked in the description below for those who want to explore that approach. For deeper education, especially around market cycles, Elliott wave, and smart money behavior, resources like the Cheeky School are invaluable. You'll find a link and a discount code in the description if you want to take your understanding further, and if you want real-time market discussion, whale alerts, and technical analysis, our community Discord is also linked below. Now, here's the paradox that defines XRP. For the system to work, XRP must be expensive. For people to trust it, XRP must not feel controlled. Balancing those two forces is Ripple's real challenge in 2026. Now that we've walked through supply, escrow, valuation logic, institutional demand, and the risks of control, we can finally step back and see the full picture. The truth about XRP in 2026 is not that Ripple is hiding a secret. The truth is that the market is only now understanding a system that was finished years ago. For more than a decade, investors looked at Ripple's massive XRP holdings as a problem, a cloud hanging over the price, a constant threat of dilution. But history has flipped that narrative. That supply was never a weakness. It was the only way this system could ever function at global scale. You cannot replace slow, fragmented financial rails with a thin, speculative asset. You need a reservoir of value large enough to absorb shock, provide instant liquidity, and support massive settlement flows. Ripple built that reservoir first, knowing full well it would be misunderstood for years. And that misunderstanding created time. While the market argued about decentralization, Ripple negotiated corridors. While traders focused on charts, Ripple integrated with banks. While critics talked about dumping, XRP was being embedded into real payment systems. The result is what we see now in 2026, utility-driven demand quietly overtaking speculation. The escrow is no longer a liability. It is behaving like the world's largest private liquidity bank. XRP leaves escrow not to chase retail buyers, but to fuel pre-negotiated institutional agreements that never touch exchanges. This is why price action feels slow, compressed, and frustrating. Supply is not leaking. It is being absorbed. This is also why the idea of a future escrow crash makes less sense with each passing year. By the time the final escrow release occurs, the market will not be waiting to sell. It will be waiting to secure access. What looks like future supply today may become future scarcity tomorrow. We are already seeing signs of a liquidity vacuum. XRP enters institutional systems and does not return. The public float tightens. The gap between visible supply and usable supply grows. This is not a pump cycle, it is a structural shift. And this brings us back to the $40 trillion conversation. That number is not a prediction, it is a consequence. If XRP becomes the primary bridge for global payments, valuation follows necessity. A system moving trillions per day cannot run on a low-priced asset without breaking. High price is not optional, it is functional. This is why Ripple's strategy around RLUSD and stablecoins matters. Stable assets anchor volatility. XRP provides depth. Together, they allow the system to scale without sacrificing efficiency. This is not a pivot away from XRP. It is reinforcement. Now zoom out even further. In 2026, the world is moving toward multipolar finance. BRICS nations are reducing dollar dependence. Europe is pushing instant settlement. Central banks are experimenting with digital rails. In that environment, a neutral bridge asset becomes extremely valuable. XRP fits that role better than any other digital asset currently in production use. Does that mean XRP is guaranteed to win? No. Risk remains. Regulation, governance, and trust will determine the outcome. But the question is no longer if XRP has a role. It is how large that role becomes. Retail investors often feel late. In reality, most are still early to understanding the mechanics. The real shift is not visible on charts yet. It is happening in agreements, corridors, and balance sheets. The greatest irony is this. XRP's price has felt suppressed because it was waiting for relevance. Now relevance has arrived, and price becomes a requirement, not a hope. The design is complete. The machine is built. The fuel is in place. The only remaining variable is adoption speed. So the final question is not whether Ripple was hiding something. The question is whether you were watching price or watching structure. If you want to stay ahead of these institutional shifts, make sure you're subscribed to We Are Cosmic. This channel exists to decode systems, not chase noise. And if you want to understand how this coming liquidity squeeze could trigger the next major market move, the next video on your screen breaks it down step by step. This is not the end of the story. It's the beginning of the transition.